Hello and welcome to Fidelity Connects, a Fidelity Investments Canada podcast, connecting you to the world of investing and helping you stay ahead. Fidelity Director of Global Macro Jurrien Timmer is back on the show today to share his latest market thesis and the macro themes moving markets this week. Jurrien emphasizes that recent economic indicators, including the CPI and jobs reports, suggest that the Federal Reserve may soon begin cutting interest rates, possibly starting as early as September. He explains how this could potentially benefit both bond yields and equities. He points out that inflation has moderated, giving the Fed room to ease monetary policy. Jurrien discusses broader market implications, such as the potential for a broadening market rally and the impact of global political outcomes on market sentiment, particularly in relation to fiscal policies and regulatory environments affecting different asset classes like traditional equities and Bitcoin. The conversation also touches on the performance of the banking sector, the global implications of Fed policies, concerns around deflationary risks, and an analysis of recent corporate earnings reports. Take a listen. This podcast was recorded on July 15th, 2024.
So there's lots of things to discuss, but certainly getting a handle on the consumer price index was one of the many pieces of the puzzle that needed to fall into place, and it did.
Yes. So let's put up slide one. So the CPI report last week was a welcome surprise. So if we go back, turn back the clock a little bit, the CPI peaked at 9% in 2022, I think it was. It fell pretty quickly to 3%, but then it got stuck there and it kind of bounced around 3.5. And then last week we had, a miss would normally be a bad thing for an economic report, but the inflation numbers missed, and now the CPI is solidly back to 3. And the core PCE, which is the Fed's preferred measure, is down to 2.7%. And then in between those two reports, we had the jobs report, which still showed growth, but less so than we've seen in the past. And so all of those pieces of data are kind of confirming that the Fed has a license to ease, basically. And in this chart, I'm showing what the forward curve is suggesting, which is that the Fed starts cutting in September. The odds as priced in by the forward curve are 95.5%, so pretty close to 100%. And then the market is expecting the Fed to lower the Fed funds rate to about 3.5 over the next few years. Whether that's ambitious or not is neither here nor there, because they're not expecting, the market's not expecting that this year. They're expecting basically maybe 2 rate cuts this year. And if you think about the math, that makes perfect sense, right? So if a neutral real rate is, let's say, plus 1%, which I think is a reasonable number in an ongoing expansion, and inflation, even if it stays at 3 and doesn't go any lower, then 3 plus 1 is 4% as a nominal neutral rate, which is higher than what the forward curve is saying. So the forward curve might be too ambitious, but even if it's 4% and the Fed has a license to return policy back to neutral, then that's 5 rate cuts right there. And so the market, of course, responds to that. And if we pull up slide 2 for a moment, slide 2 shows all rate cuts going back to the 1950s. Is a little bit of a squirrely chart, but if you look at the blue lines in the bottom, you can see that, of course, there were a few super bear cycles, the dot-com bubble, the financial crisis, and the market obviously went way down, even though the Fed was cutting. But oftentimes, when the Fed starts to cut rates, the market either goes straight up or it goes down first, but by a modest amount, 5, 10, maybe 15%, and then it goes up a lot. So the fact that we are, so far at least, in a soft landing environment, and the Fed has a license to cut, obviously is pretty constructive, not only for bond yields, but also for equities. And we certainly saw the reaction to that happen in a very big way.
Yeah, it's just fascinating how all of this has worked. Now, over the weekend, we know some of the events that happened, and let's take a look at the asset classes that have moved around for the so-called Trump trade. The idea, should we start with interest rates? I don't know which piece of that story you want to begin with, but we've seen a lot of movement, obviously.
Yeah, so obviously very significant events, and I shudder to think, what would have happened if things happened slightly differently, what the impact would be not only, on markets, but on just the culture being such a divided country. So, thank God that, that didn't happen. And so the markets have sort of, I don't know if it's premature or not, but the markets are certainly betting that this will be an easier election outcome, or a clearer election outcome than maybe we were all expecting. And so for the markets, regardless of which side of the aisle you're on, for the market, it creates some perceived clarity. And of course, clarity is good. Markets don't like uncertainty. And so if you add up, kind of the outcomes in the market of different election outcomes, right? A Republican, a Democrat, a gridlock, or a sweep. The markets generally like gridlock, but they also like Republican sweeps. And I don't, that's not a value statement of any kind, but I think Republicans are generally seen, rightly or wrongly, as more pro-growth. And obviously the stock market likes that. The market likes lower taxes and less regulation, things like that. So if that's the scenario that we're getting, it should bode well for the stock market. And you can see the stock market's already sort of voting. What happens to interest rates is another question. That's a harder one to pin down, and that gets us back into the conversation about fiscal dominance that we've talked about, right? So we know that deficits are going to be there no matter who wins. So that's not a partisan thing at all. The country is just in such a place, and not just the US, but everywhere, Canada, Europe, Japan, China. The world is in such a place where, between entitlement spending and debt service and other non-discretionary forms of government spending, that there's very little room to really cut, right? So there's not a lot of room for austerity. Obviously, default is not going to be in the cards for any of these large countries. And then it's just a question of how sustainable is the debt when deficits are going to continue, and which country has the best choice or option to grow out of that debt. What happens to the central bank in an era of fiscal dominance? Like the Japan is, of course, one extreme where you have a central bank that is clearly subordinate behind the fiscal side. In the US, the Fed used to be like that in the 1940s, but of course it's now independent. But again, in a Republican sweep, what happens to the Fed's independence? Who ends up sitting on the Fed's board? And are they going to be more hawkish or more dovish? And so those are questions without answers right now. We do know that Powell's term comes up in 26, and I believe Trump has already said he would not reappoint him. And of course, they were not super fans of each other the last time around. And so, I don't know what the answer then is for bonds, whether they're well bid because the Fed might be more dovish and therefore might be more inclined to do QE, or whether yields would go up because in an era of fiscal dominance, maybe a term premium will return to the pricing of the bond market. And so that one I don't have an answer for, but for equities, it should be net positive. And of course, we saw a very large move in Bitcoin over the weekend because one party is clearly pro and the other party is clearly skeptical or against. And so if we have a sweep, you're going to have all new committee chairs. Gary Gensler at the SEC will be gone. And so you might have a more Bitcoin friendly regulatory environment. And clearly the price of Bitcoin is responding to that. But with Bitcoin, you always have to be a little suspicious that it's just some people pumping it. So I don't want to overthink the price action in Bitcoin.
Okay, fair enough. I wanted to get your comments on it. You gave us that. I'll come back to sort of what happens in Fed easing cycles, and we'll talk about that in just a sec. But the dollar is a really interesting one in there. Okay, so you have the Bitcoin action, and then you have the safe haven of the dollar in many different moments. It's been discussed that the dollar will perhaps come down in value on a global basis, but we saw this surge back. Just tell us a bit about the dollar. Help us understand that asset class for a second.
The dollar is a really interesting one. So if we pull up slide 3, so the initial response, of course, is that, okay, a Fed easing cycle is now going to begin. It may not be as severe as what we've seen in the past, maybe from 5 3/8 down to 4, but still it's a piece of the puzzle of why the dollar has been strong, which is that the Fed tightened more than anyone, more and quicker than most other countries, and it stayed tight longer than most other countries, right? The ECB, Canada already easing. Japan, of course, remains very dovish. China was easing as well, but the US was not, and that kept the dollar propped up. And you see in this chart, this is the daily chart of the US dollar, and the purple line is the 2-year yield, which of course is a good proxy for where the Fed is expected to go. And I almost think of it as like a puppeteer holding up like marionettes, right? It's holding the dollar up. And now that a Fed easing cycle presumably is beginning, that removes a bullish prop from the dollar, which allows the dollar to come down. I mean, it hasn't gone down a lot, but that actually harkens back to what we used to call the reflation trade. This was in the aftermath of the financial crisis when
Which is a
China
global
kind of,
thing, right? This
yes,
is
a
like a
global
global
thing. So
story. Yeah.
yeah, so what happened in '09, of course, the US started quantitative easing, and that kind of unleashed the animal spirits. And then the Chinese government did a gigantic stimulus. I mean, it was enormous. And that, that was still at the time where China would stimulate through like infrastructure, airports, roads, buildings. I mean, China's in a different place now. But that was the reflation trade. So the dollar would go down, yields would go up. So rising yields was still a good thing back then because it meant that things were improving. Commodities would go up, emerging market stocks would go up, and the junkier parts of the US market would just rip. And so that was the reflation trade. And that would happen in subsequent years whenever the Fed had to back off from ending quantitative easing, et cetera. And so last week's action kind of had a little of that feel to it. And I'm looking for the chart here.
Oh, yes.
Slide 4. I just want to show you what happened to the MSCI EM ex China index. So these days, we have to kind of strip out China to see what the rest of emerging markets are doing. And that's the blue line there on the top. And it just absolutely soared. And so that is a kind of a sign of the reflation trade. It needs a weaker dollar, of course, because essentially EM countries and companies are short the dollar, right? The dollar is the funding currency. So if the dollar goes up, it's like they're getting squeezed. And if the dollar goes down, it's the opposite. But even if we go to slide 5, even like another sort of obscure asset class like silver, that's a good chart. That's a head and shoulders bottom there. And so things are sort of moving. And part of that trade is a broadening in the market, right? And we saw that, of course, on Thursday. And actually, let's pull up slide 13. On Thursday, the Russell 2000, which of course has been in the doldrums for some time, went up 3.5%, while the Mag 7 index went down 4.2%. So that's a
fascinating rotation. You have to take us through this. That was something to watch.
That's a nearly 8 percentage point, reversal, and so and that's actually continuing. But it's so that of course is good because we want to see the broadening. And if we look at slide 9, you can see that the cap-weighted S&P index continues to make new highs, and the breadth number, which is in the bottom there, the percentage of stocks above their 200-day moving average is now at 75%. So that's all good. And actually, if we go to the next slide, the equal-weighted index.
Ask you in there, when that rotation was happening, the markets actually were off briefly.
Yes, and we'll get to that in a moment, because that actually, to me, is one of the more critical things that we need to try to figure out, and I don't know if there's an answer for that. So let me get to that in a moment. But slide 10, this is very encouraging because this is the equal weighted index, and it has been sitting around in a trading range for a while, and now it looks like it's breaking out of a what we call a contracting triangle, which is a continuation pattern. So in the absolute, so there's the absolute breadth of the market, percentage of stocks going up, down, new highs, new lows, and then there's the relative breadth. And so what we're seeing is a very big dichotomy, and let's pull up slide 14, between those two. So the absolute breadth of the market is fine, right? Market's in an uptrend, making new highs. We still have some life left. Earnings are now growing and actually accelerating. A second quarter earnings season is now underway. So, and the Fed is now pivoting. So all of that is really good. And also, if you look at the PE for the equal weighted index is at 17.5, which is not high, even though for the cap weighted index, it's at like a 24. So even below the surface, once you strip out these big growers, the market is not expensive. Earnings are growing and the Fed is now going to be easing. That's a pretty good backdrop. But the caveat is, how do we think about this lack of relative breadth? So if we pull up slide 14, I'll show you the kind of the dichotomy. So the orange bars is the new highs minus new lows. So that's another version of breadth. And you can see it's been pretty robust, right? So more companies making new highs than new lows, which of course is what you would expect in an uptrend. I mean, that's what stocks do in an uptrend. They make new highs. But on a relative basis, so a stock making a relative new high, so relative to the index, that has been very narrow. Those are the purple bars there. And you can see the market since last fall, when the Fed pivot was originally starting to get priced in, has been pretty broad. It's been a good market, the bullish broadening, as we've many times discussed. But the kind of narrow relative leadership that we're seeing typically only happens at tops, and that you can see it in the red shading there. That's when relative breadth is narrow, and that tends to happen near tops, although the last 6 months, of course, that's not been the case. But to get to your question, last Thursday, right, so the Russell was up 3.5%. The S&P equal weighted was up more than 1%, but the cap weighted index was down almost 1% because the Mag 7 were down 4%. And that, I think, is something we need to really think about, that it's sort of a careful what you wish for, right? If you want to see the market broaden, at least on a relative basis, can that happen in an up market, right? I mean, are the Mag 7 so big, Nvidia's 3 trillion, Apple is up there, Microsoft, are they so big that if you get the rotation out of those stocks into everything else, into the other 493, can the market actually go up when that happens? And that would be something that may not be on many people's bingo cards, right? Because you figure all these fundamental things are happening, they're good, but yet the market's going down. How can that be? And that is one way that could happen. It's not my default case, but we need to think about that as a possible scenario.
So even if you were, in theory, sort of waiting in small caps for, say, CPI to come in, or whatever the signal is going to be for the cut, the sort of more prolific signal, even if you're waiting there, the overall markets may pull back. That basically.
Yeah, and I think it creates a scenario where an investor might want to be more specific, right? Where you're buying mid caps or small caps, and maybe if there is an equal weighted index version, that maybe you buy that rather than relying on the regular S&P 500 to lift all boats. And it's interesting because if you think about the math, right? So the S&P 500 year to date is up, I think, 18%. And the equal weighted index is up like 7%, I think. So that's a difference of 11 percentage points just year to date. Same index, but a different way of composing the weights. So that means that if you're like an average stock, normally you would have to go up more than 7% to outperform. So that's not a heavy burden. But in this market, you need to be up more than 18%. You need to be up more than 1,100 basis points higher than the equal weighted index to actually outperform the index. And for many investors, it doesn't really matter, right? You want to be in a market that's going up, and you want to be in the right asset classes. It's more of a beta question than an alpha question. Right. But if you're in the relative game and you're an active fund manager, that's an important thing. And being on the right side doesn't necessarily mean the market even goes up. And so on a relative basis, that doesn't really matter. But it's kind of a nuance that we don't really have to think about very often. But the market is concentrated to a degree that it's rarely been in history.
Fascinating how all this works. I wonder if we can just break away for a second and just talk about earnings. Like there's a slew that came through this morning. We're at the beginning. I know you have thoughts on, them continuing to look really good. The banks have looked quite good. There was a discussion about within the banks, sort of almost putting the consumers to a side. That was one of the discussions I was listening to. So the banks that are just more consumer exposed, which has to do obviously with mortgages and everything else, versus those that have very strong sort of investment banks and FIC and lots of other options to rely on for their earnings. I was thought it would be interesting to ask you a little bit about the interest rate story and the pull away from the consumer a little bit. Like what is that story in the banking earnings right now? And then maybe earnings more broadly.
Yeah, sure. We can pull up slide 12. And I meant to mention that earlier that this rotation we saw last week, it kind of makes sense, right? Because if the rest of the market, other than the Mag 7, have been held back, they've been held back for several reasons, but one of them is the heavy hand of the central bank, keeping financial conditions tight, cost of capital high. Once that we get some relief on that, a lot of these companies can breathe again, right? Companies that have weaker balance sheets or that are more sensitive to interest rates, right? Like the Mag 7 are not sensitive to interest rates because they have so much cash, right? And so it makes sense that the market would broaden once the Fed starts to ease, provided that it's not easing in a recession, right? So if it's a soft landing ease, then it's really, really good for the broader market. If it's a recession, then of course the banks have another set of problems to deal with. But in terms of the banks, it's a logical distinction between, let's say, the smaller community banks or regional banks that have to deal with commercial real estate, with credit cards, consumer debt, and clearly there are some signs that the consumer is spending less money. Those excess savings are from the pandemic are gone. Interest rates are biting at some levels, and so but the really big mega banks, are doing just fine. Their cost of funding is the deposit rate, and the deposit rate basically never went up. It's still 0.5% on average, even though the Fed is at over 5%. And so for banks, the yield curve is pretty steep for the big banks, that is. So I can see how you would make the distinction between more consumer driven rather than more kind of big diversified banks. And you saw the Goldman Sachs earnings, a lot of trading revenue, markets going up. But overall for earnings, this is my typical chart where I track the weekly growth estimates going into earnings season, which is the vertical line. And this has been really interesting so far because usually those lines go down. You can see there's definitely a typical drift, and that's because companies like to under promise. And then during earnings season, it goes up because companies are expected to beat earnings estimates, so they like to under promise and over deliver. But that black line, which is the Q2 estimate, which is at 9%, really has been very flat, and it's already near double digits. And typically you get a 3, 4, 5% bounce during earnings season. So we are probably going to end up with a double-digit earnings growth, which is again a continuation of the sequential improvement in earnings since last fall. And if we go to slide 11, you can see the juxtaposition of the valuation side to the earnings side. So the change in the PE ratio is the purple bars, and change in earnings is the blue bars. And you can see that generally when one is up, the other is down. So generally price is ahead of earnings, which is why market timing is so difficult, because it often doesn't make sense what you're seeing in terms of the price action. But you can see those blue bars on the right there. Those are the estimates for this year going into next year, and they're pretty robust. And so we should be at a point where the baton is passed from valuation to earnings. And of course, the best bull markets are ones that are driven by earnings growth and are not too expensive. This one is expensive on a cap weighted basis, but not on an equal weighted. But again, I come back to, the relative breadth is a problem. The absolute breadth is fine. But if that relative breadth broadens out and we go from a narrow leadership market to a broader one, can the market actually go up if that happens? And I don't know that it's a question for today, but I think it's something we're going to be thinking about. So
there's a great question. Yeah, it's almost sort of a mind puzzler. I'm going to see how that comes out in the wash. I'm sure we'll be asking about that. This is a question that's just come in, Jurrien. Do you think that austerity will eventually happen, possibly in Canada or the US? How can governments continue to add new spending and programs without removing something?
Yeah, I don't think austerity is likely. And you look at the two candidates in the US, I can only speak for the US here. They're both kind of populist. Neither of them have any problem spending money. And the entitlement programs in the US, with the demographics, it's probably the same in Canada, are so massive. And the demographic, the age wave, right, of an aging population are so large that unless you make changes to the entitlement, like you raise the Social Security age or what have you, those numbers are baked in the cake, right? And then you add defense spending, which is likely to remain robust no matter who wins. And then you have debt service, which is already $1 trillion out of a $6.5 trillion budget. And there's very little room to actually cut spending. And even if you were to raise taxes, which now seem less likely, right? The Trump tax cuts, which happened in 2017, will sunset in 26, I believe. So that will likely not happen if there's a Republican sweep. But even if taxes were to go up, it would be a drop in the bucket with deficits that are 7% of GDP. So the only real hope is to grow out of debt, right? And so that's what the US did after.
Is that inflationary necessarily?
So if you think about it, right? So debt to GDP is what people worry about. So the debt is 34 trillion. It's an enormous number, but it's the debt to GDP, right? So if you're a company and you're borrowing money and that money that you're borrowing makes you grow faster, then there's nothing wrong with debt, right? So debt on its own is not a problem. But if you spend it unwisely and you're not growing, then that debt becomes a burden because you're gonna spend more of your revenues on debt service. So the key is to be able to grow out of the debt the way the US did after World War II. And it's hard to do that because the demographics are just not there. So it has to then come from productivity. So is it the AI boom that maybe helps us with that? Is it a more pro-growth, administration? It may not be enough, but again, this is a problem the world has. And if the US is in a relatively better position than Europe or Japan or China, then, that might be enough. That it's the cleanest dirty shirt, syndrome. So it's a really complex.
Drag Canada along with it, if that's the case.
Sure. But anyway, it's a very complex question. But it will end up being growth and inflation, the combination, right? It's debt divided by nominal GDP. And you already see, like during the pandemic, of course, the spending went way up, right? It was a $5 trillion helicopter drop. But since that time, nominal GDP, which of course, part because of inflation and part because of growth, has really gone up a lot. And so the debt to GDP in the last couple of years actually has gone down. And so that really becomes the key to solve for. Obviously, you want to keep the debt under control. But if you can grow your nominal GDP faster than the growth of the debt, then the debt can still be somewhat sustainable.
Right. Fantastic. So interesting to get all of your thoughts here. We'll leave it there. Jurrien Timmer, thank you very much for joining us and starting us off on a pretty fascinating week. And we're very grateful for your time.
Thank you very much. Have a good week.
Great. You too. Jurrien Timmer.
Thanks for listening to the Fidelity Connects podcast. If you haven't done so already, please subscribe to Fidelity Connects on your podcast platform of choice. And if you like what you're hearing, leave a review or a 5-star rating. Fidelity mutual funds and ETFs are available by working with a financial advisor or through an online brokerage account. Visit fidelity.ca/how-to-buy for more information. On fidelity.ca, you can also find more information on future live webcasts, and don't forget to follow Fidelity Canada on Twitter. Thanks again. See you next time. The views and opinions expressed on this podcast are those of the participants and do not necessarily reflect those of Fidelity Investments Canada ULC or its affiliates. This podcast is for informational purposes only and should not be construed as investment, tax, or legal advice. It is not an offer to sell or buy, or an endorsement, recommendation, or sponsorship of any entity or security cited. Read a fund's prospectus before investing. Funds are not guaranteed. Their values change frequently, and past performance may not be repeated. Fees, expenses, and commissions are all associated with fund investments.